Hey puppy trades. I wanted to do a video analysis update of the stock market. I'm going to talk about 27 stocks. I think the video is going to be called my top 25 stocks to define risk for 2023 and beyond. But I am going to talk about 27 stocks, probably a few more, and they're not in any type of order. They're not in any type of order at all. So I'll just get right into it. In my last video, I talked a lot about risk management. So I really only just talked about my plan for if this is completely wrong. And then I realized, oh crap. Oh crap. I forgot to, tell the folks what I think. There's a group of people who counter trade me. A group of people, they make a lot of money doing the exact opposite of what I say. So I need to make sure that I don't do them a disservice. So we're going to get into what I think about the stock market for 2023 and beyond. But that's completely secondary to what my actual goals are as an investor. And that's to always be prepared to be completely wrong. And more importantly, to be prepared for nothing to happen at all. So I built a very extensive system around collecting option premium from covered call ETFs and also dividends from dividend income and dividend growth stocks and protecting the directional risk of that yield with long gamma delta neutral option straddles. So that's that's my real priority, right? And that risk management system allows me to develop a bias to the upside. Not always to the upside, but I can't really think about the upside if I'm not ready for the bear porn. Okay. And I want to congratulate everyone in the FinTwit community. Not necessarily just the people watching this, but even the people not watching this. I know you have a passion for the stock market and investing and developing your own opinions about where you think asset prices are going to go, because you understand, hopefully, it's not just to take part of a larger conversation. It's not just to enhance, the wealth of your own family after you speak to a certified financial advisor. And if you choose to make your own investing and trading decisions, I think that there's a lot of people on FinTwit who do actually do that. And unfortunately, there's people on FinTwit who don't, and they sell their opinions for money. And in America, there's nothing wrong with being an entrepreneur. But I want to congratulate everyone in the FinTwit community, the bulls and the bears, because this year, whether we crash below 200 or explode below 600 for SPY, this year was to get people out. Everyone out. Bears too. This wasn't an easy short. There were some people said this was a forgiving bear market, if that's what it ended up being, where we had a lot of counter trend rallies. We had a lot of times where, the bulls could have said, oh crap, that was scary. I'm gonna buy some delta neutral positions. I'm gonna start thinking about maybe taking some profits on these and scaling into buy right ETFs. These aren't easy to catch, especially with options. The decay on the options is gonna wipe out puts. That's not so. And even the borrowing rate for a short, that's not easy. That's an extremely difficult position to manage. I was actually able to catch a good amount of, some of this downside action with my straddles on the Metaverse ETF, some of my earlier straddles on ICLN, my straddles on Credit Suisse, my straddles on AG&C, and, a few straddles on the energy stocks that went to the upside. But It's not easy to catch the downside in the market. Anyway, this year was to get everyone out. And in my last video, I talked about what if that, was to get people out of the big short, and how I am, prepared for that. But I don't think that's what it was. I think it was to get retail out of something much different. So I'm going to go over that in this video with 27 charts, and they're not in any particular order. But here is SPY. I think this is a wave 1 and a wave 2 from the March 2020 low. And we have ended an ABC correction at the 50% retracement of this rally. So if we hold above this low of 348.11, then wave 2 is in on the larger degree. And we formed a wave 1 and a wave 2 from this low. And we're going to begin a large wave 3 of wave 3. We'll talk about the charts in this market that may be supporting that idea. Some like Starbucks, some of the financials, some even industrials like Boeing. They already have started, perhaps impulses from these lows. So we're going to get into those charts as well. But I think this is a wave 1 and a wave 2. If we're above 348, the bulls are going to say wave 2 is already in. The length of wave 1 placed at the wave 2 low can take SPY to an equal legs target of 610. And that would be a minimum wave 3 target before a shallow wave 4 and a wave 5 higher. So the widest invalidation for SPY, if that level were to go, which I don't think it will, is 318, the 61.8% retracement. But there's a lot of ETFs and, foreign market, stocks where the onus right now is on the bears to get below this low and say this isn't a wave 1 and a wave 2, and we're getting ready for wave 3. We'll talk about why that's a very important question to ask with more stocks in this video. Here is VIOG. It is a small cap growth ETF. I just think it's a really pretty view of small caps. I think this is a 1, 2, 3, 4, 5 waves impulse that forms a large wave 1. This is an ABC correction that ends wave 2. And we have another wave 1 and another wave 2. So if we're above the 61.8% retracement of 156.70, I'm looking for VIOG to go the length of wave 1 placed at the wave 2 low and go on a wave 3 all the way up to an equal legs target of 322 before a shallow wave 4 and a wave 5 higher. It's very similar to SPY. I think it's a very pretty 1, 2, 3, 4, 5 waves up. Now an ABC correction. We're taking the length of wave A, placing it at the wave B high. Looks like it's where wave C ended. It doesn't guarantee anything, but from an Elliott wave perspective, it suggests we could begin. We could have ended this correction and we can begin a new impulse to the upside. So we'll talk about more examples of another wave 1 and wave 2 forming from this low. I think this is a 1, 2, 3, 4, 5 waves impulse for XLI and another ABC correction. That looks like it ended between the 38.2 to 50% fib. So this is another one where the bulls are going to say, hey, that's a wave 1. And I know it's a little wide right now, but in some ways that's a good thing because it's been a pretty nice impulse for XLI that as long as we're above this wave 2 low in the larger degree, it looks like we could have begun an impulse to the upside. And I think I've left a couple, big clean energy names that I talk about a lot, like In-Phase Energy and First Solar out of this video. But we have seen some. I talked about a few videos back how First Solar and In-Phase have begun kind of larger cycles to the upside too. Now we're starting to see a more broad view, and industrials have joined the party. Financials may be joining the party, where I believe Caterpillar got very close to breaking this high during this wave 1 rally. So the bulls are going to argue that if XLI is above this low of 82.76, I like the 50% retracement of 77.79, but for the wave 1 and the wave 2, if it's above 82, then this is a wave 1 and a wave 2, and we've already begun an impulse to the upside. So that's a nice invalidation level for the bulls. Here is Abbott Labs. This is a healthcare name to kind of express a similar idea. I think this is a 1, 2, 3, 4, 5 waves impulse that forms a large wave 1 and an ABC correction that ends a wave 2. We've seen XLV, we've seen Pfizer, we've seen Merck. I just wanted to add another healthcare name like Abbott Labs to show that the kind of, a lot of people pointed out that the healthcare sector has already begun, a little bit of a rally in the similar way that the industrials have already begun a little bit of a rally. So if Abbott Labs is above 91.78, the 61.8% retracement of this wave 1, it's already ended wave 2, and we can begin a wave 3 to the upside. The length of wave 1 placed at the wave 2 low can take Abbott Labs all the way to 174. So that's Abbott. Here is SOXX, the semiconductor ETF. It's very similar to Nvidia and AMD. I believe that this is a wave 1 and a wave 2 from the 2018 low. This is a large wave 3 and an ABC correction that's ended wave 4 at the 61.8% retracement. So if we're above this wave 4 low, the bulls are going to say that SOXX already ended this correction at 287.82, and we're going to begin a wave 5 to the upside. So the length of wave 3 placed at the wave 4 low would give a wave 5 target of about 677. Now, a wider level, I like this low to be held in above, but a wider level for a wave 4 is the wave 1 high, because there's an Elliott wave principle that says wave 4 retests the wave 1 high, and then wave 5 is either the length of wave 1 or the length of wave 3 placed at the wave 4 low. So wave 5 is the length of wave 3 placed at the wave 4 low. That gives SOXX a wave 5 target of about 677. The pick the low level is 287.82. The wave 1 high is a little wider of an invalidation of about 267.93. That's SOXX. It kind of lines up from a price perspective with AMD. So Bar Chart did a update recently, and I wish Bar Chart would ask me before they do these updates, because they always mess up my fibs. So sometimes Bar Chart will mess up my fibs. I love Bar Chart, so I'll forgive them. But here's AMD. It forms a 1, 2, 3, 4, 5 waves impulse to the upside. I believe it's ended in an ABC correction, and it too, like SOXX, like Nvidia, just going and breaking this wave 1 high would be a substantial rally for the bulls, and defining the risk to the upside would certainly be done there. It'd be done by taking the length of wave 1, placing it at the wave 2 low, and getting a wave 3 target that would sound ridiculous right now. Now, the 78.6% retracement of 36.46 is also a little ridiculous of an invalidation for AMD, but maybe this might be one of those pick the low levels that could be worth it. The bulls are going to argue that AMD, Nvidia, kind of like XLI, kind of like Nvidia, the onus might be on the bears right now to go say, hey, go break that low, prove that this isn't an impulse to the upside. If I try to go measure this out and do all that, it's going to mess up all the rest of my numbers. But basically the idea is that if we look at the daily chart, the bulls are going to argue that AMD has formed a wave 1, 2, 3, 4, 5 waves up. And so, hey, bears, go break that low, go get below 54.57. A lot of bulls don't like doing that, but that's risk reward, and that's also why I have straddles on the Metaverse ETF. I have straddles on bets. I have straddles on ET and AT&T and AGNC, because I'm ready to call the bear bluff. I'm ready to go a lot lower than AMD breaking below 54.57. So that's what I outlined in my recent video. But the bulls are going to say, hey, why is this not wave 1 and wave 2 in a wave 3 to the upside? For me, it's because I don't really trade the daily chart like that. I'm more of a weekly and a monthly guy. But here is Nvidia, and that also goes into my larger system of making a lot of it around, or all of it around, collecting premium from covered call ETFs, collecting income from dividend stocks. So anyway, here is NVIDIA. The bulls are going to argue that this is a 1, 2, 3, 4, 5 waves up, an ABC correction that ended between the 61.8 to 78.6% fib. So with AMD, with SOXX, why is this not a wave 1 and a wave 2? And if we're above this low of 108.13, which is just only $10 away from the 78.6% retracement of 98.60 that we have begun an impulse to the upside with XLI, with XLV, with some of the financials. So that is in the bigger view for NVIDIA, is that would take it beyond this wave 1 high of 346.47. So that's NVIDIA. Here is silver. I wanted to get some commodities diversification in the video, because for me, it's all about, getting that lower correlation coefficient. One second. It's all about getting that lower correlation coefficient in my portfolio. So SLV, I don't have this correlation coefficient right off the top of my head. If I went to etfscreen.com, I certainly could. So I believe I've shared that link recently. Maybe I'll put it in the description of my video, but etfscreen.com gives ETF correlation coefficients to, or for ETFs to the S&P 500 ETF SPY, and it's extremely useful. Another very useful tool that I found to be very awesome is Macro Axis. It's completely free, but it gives the 3-month kind of correlation and beta analysis for any stock or ETF in the market compared to any other ticker. So it's really interesting. I think I'm going to, start using ETF Screen, and I've just been introduced to Macro Axis for correlations and stuff like that. And this wasn't really planned to be part of the video, but the bottom line is commodities diversification is extremely important to me. Diversification in general is extremely important to me. And some people say that they quote the stupid Warren Buffett quote that diversification is the hedge against ignorance. Okay. First off, Warren Buffett's more diversified than most retail traders. He's a lot more. If you look at Berkshire Hathaway's holdings, it's a lot more diversified than, the average stock Twitter on the SPY board, so to speak. But Warren Buffett's also one of the biggest option sellers in the history of mankind, by the way. So don't say diversification is a hedge against ignorance and say that covered calls and stuff like that are for retail bag holders, because I know a lot of you guys say that. Warren Buffett is an insurance salesman. Okay, he's run the buy right longer than most of the people watching this have been alive anyway. He's not as against diversification as you might think. He loves selling options. I heard that. Anyway, here's SLV. I love the metals, 1, for the wave count, but 2, also for, with the rest of the commodities, lowering the average correlation coefficient of my portfolio, just because that's a really important thing to do. Anyway, here is SLV. This is a wave 1 and an ABC wave 2. This is a multi-decade. It's a 1-decade cycle playing out. I mean, and so, yeah, it takes time, right? But this is a large wave 1 and an ABC wave 2. And that's why it's important for me as an Elliott wave theorist to play the long game, because I'm focusing on these larger degrees. Okay, the money selling discord is made focusing on these degrees, right? This is where the discord money is made, going up to the 1 month, the 3 month, the 5 day, and fiddle faddling with this crap down here. That's where the discord money is made. But the bigger money on the bigger time frames with the lower tax penalties is made on the weekly and the monthly charts. And that's, something that I'm going to prove. I think I've seen how the institutions are using these straddles, like straddles that they bought on SLV, to accumulate during a period where they can buy against the in the money puts of the straddles. So let's say they buy a lot of straddles right here and then SLV falls. They can buy against these bloated in the money puts based on the delta equivalency, which is something I really went over in my last video. And now they've held these shares for close to a year. So let's say 2023 rolls around and now they start distributing up here. They're doing it after buying and holding these shares for longer than a year. Anyway, that's speculative for the moment. What's not speculative, one, is that they bought lots of long gamma positions here. I can certainly prove that. And I believe now we can see that they've bought as many shares as they could against those in the money puts. They're riding this wave up. I think it's a wave 1 and a wave 2 that ended between the 61.8 to 78.6% fib. The length of wave 1 placed at the wave 2 low says SLV will be above whatever that exact low is, 16.19, and go to a wave 3 into the low 30s. So that's SLV. Here is palladium. Palladium I posted about recently, so I'll go through it a little quickly. I think it's a large wave 1 and a wave 2, a 1, 2, 3, 4, 5 waves up for wave 1 and wave 2, and now another wave 1 that broke this wave 1 high in an ABC correction. So the bulls are just going to say, hey, break below 143.06. A little wider is this low right here of 137.51, which is very nearby. And we're going to say this is the nest. The length of wave 1 placed at the wave 2 low says that wave 3 going above 300 to 306 is just a minimum expectation above 143.06. So that's palladium. Here is Tesla. We look at Tesla. I am going to hold Tesla in a lot of growth, like Alibaba, and I know Camping World's not growth, but there are some bags that I'm holding. Okay, there are some bags that I'm holding, and they're small bags because I took a lot smaller positions in them than I do more value sectors, more dividend paying sectors, more fundamentally backed sectors, and I've made that extremely clear. I bought Litecoin with a half position size at 229. I bought Alibaba with enough money to lose to zero at 165. I bought Huya with a very kind of measured position size at not in the 30s, in the kind of mid 20s, and I think it's like at 3 now. I bought Lordstown Motors with a half position size at 20, and it's damn near zero. Okay, but I'm doing fine. Life is good. My biggest concern is taxes right now for March and April, because I have done exactly what I've said I've done. I've bought a dick ton of straddles. I've loaded my bum up with covered call ETFs all year on the small caps and IWM, on the techs and the market. And I've loaded up the dividend sector. And I've been extremely clear about my commodities diversification and how I'm taking larger positions in these names. So as small caps and growth and, has gotten hit and it's taken its time, I'm still collecting premium. I'm reinvesting premium. And to be honest, it's in my best interest that we stay down here. Just give me more time. Just give me higher yields. I have straddles that are in the money already on the Metaverse ETF, on bets, on AT&T, on AG&C, on ET. If the market crashes by the time SPY is below 348, I don't have enough money in the world to offset that bearishness of my put delta if I don't make any adjustments and just let it free fall with the market. And then in that scenario, we would see the implied volatility on the covered call ETFs explode, and I'd be getting massive premiums. And the most of my holdings are having a beta of 0.70, 0.80, and my straddles are on stocks and ETFs that have betas of 1.30, 1.50. And that's all stuff I made clear. But when I posted about that stuff, 2 likes, 3 likes. Hey, what about Pounder? Hey, what about the stock that broke below your stop, that you posted about? 7 months ago. You know what I mean? Hey, you're just talking about the S&P 500 now and the big tech stocks and the market and, your, risk management positions. And it's like, I get that stuff isn't sexy, but in real finance and real investing, that's everything. The bias that is in this video is a super small part. It's not me who came up with a general rule of thumb that for high risk, high reward, kind of 10x or bust plays, that's less than 5% of the portfolio as a very general rule of thumb, as an extremely general rule of thumb. The covered call ETFs, my position right now in JEPI is about 9 times my position in Tesla. If we're talking about just including RYLD and XYLD, I might be at over 30 times in those than my position in Tesla. If we're talking about my straddles as a whole, for the calls and the puts, the current value of that's, I think, about off the top of my head, that might be 6 or 7 times, maybe 10 times my position in Tesla. Actually, I think it's a lot more than 10 times my position in Tesla. Even just the puts are probably, 7 or 8 times my position in Tesla. That's how important risk management is to me. But that's not what's sexy. That's not what gets thousands of likes. Like, look out. Look out. SPY could go below 200. The market could crash. The baby boomers could lose everything. Do you think that's a joke? Of course that's a possibility. Yeah. Yeah. The baby boomers could lose everything. The lost decade could begin. We could have the Great Depression. This could be 1929. And I prepared for that. But I've also prepared for the early 1990s. That's what I expect. Here is Tesla. I think it's a 1, 2, 3, 4, 5 waves up. Wave 1. And a wave 2 between the 61.8 and 78.6% Fib. Also the early 1920s. Also the early 2010s. Just from a maybe perspective of what can happen if this is a large wave 1 and a large wave 2. And with other stocks in this video, a little more techy, a little more growthy. A large wave 1 and a large wave 2. I'm in Tesla till it goes to 0. I'm in Tesla till Elon Musk. But right now, 97.98 is pretty tight. It's the 78.6% retracement of a 1, 2, 3, 4, 5 waves up impulse. So it's a little tight for Tesla. It's also, if I, measured this, it's pretty damn close to where the length of, if this was a wave A and wave B, where wave C would be. So the institutions aren't using stops. They bought lots of straddles in this range for a ride up, and in this range for a ride up. And for both of them, what they did was they loaded a lot of straddles in kind of these ranges. And then against these corrections, they were able to buy against the in-the-money puts risk-free to ride the next wave up. I believe that's happening on a larger scale, where they bought a lot of straddles up here, and now they're getting to buy against those in-the-money puts of those straddles based on the delta equivalency. So the deeper and deeper in the money an option gets, the more it's akin to just having, in the case of puts, a short position on the stock. And so the higher the delta of the put gets, the more shares they can buy. So if they bought a bunch of straddles right here, for example, when the delta of the call and the delta of the puts was 50, and now down here The call is basically worthless, but the put's real deep in the money. The straddles got a nice little profit, and the put's got a delta of negative 90. They can buy 90 shares of Tesla against that put and ride the next wave up without having to stop. So 97.98 is real tight. I'm in Tesla, and if it goes below 97.98, I'm going to add a little more. Okay, I invested enough for it to go to zero with a smaller position size, and I'll just buy more growth stocks, have more and more premium, have deeper and deeper in the money puts on the metaverse ETF, on bets, on the rest of the market, if that happens. But I don't think that's going to happen. I think this is an ABC correction. This is large wave 1 and wave 2. Tesla's going to begin a nice wave 3 with NVIDIA, with AMD. So while we're on a growth stock that's made a new low, it might be a good time to say that what some Elliott wave theorists who aren't comfortable with risk management tactics besides stops, which is fine. Everyone is entitled to their own opinions. They'll say that the proper thing to do is to wait for a stock like Tesla, a stock like Roku, a stock like Palantir, a stock like Space to form a 1, 2, 3, 4, 5 waves impulse that forms a wave 1, buy against the wave 2, and go for a wave 3, 4, and 5 higher. So that's probably going to be a very applicable thing for a lot of growth right now, like Neo, like Roku, like Bitcoin, like some of those stocks. And for a lot of them, I'm trying to get, like in the case of Tesla, other neighboring stocks where there are nice lows to be above, right? So for example, even though Tesla's made a new low, I'm pretty bullish AMD and NVIDIA. I'm pretty, comfortable myself thinking that, we are going to see these names make a big wave 3 higher, right? We are going to see SOXX hold above this low and make a nice impulse to the upside. I do believe that's going to happen. So I'm using, in the case of Tesla, NVIDIA and AMD and SOXX as kind of neighboring stocks for them. I had Tesla a little bit. No, I had Petróleo Brasileiro a little out of order. Anyway, I meant to have PBR with UUU and IEO, but I'll talk about NEO right now because it's very similar idea to Tesla. It's also pretty applicable for the NetEase chart and the Alibaba chart as well. Those have nice little levels to be above. But I think for NEO, this is a 1, 2, 3, 4, 5 waves up and an ABC correction at the 78.6% retracement. I think this is a large wave 1 and wave 2. It's similar to Tesla, where I believe the institutions, and I know the institutions, have used straddles to buy, just like they used them on the way up, by the way. And just like for Tesla, they used them on the way up. Now, I don't care about being right and being, because that's not where the money's made. The money's made on investing in the casino, investing in the insurance company. It's not made betting on the car crash. Who's gonna, get the big payout from, the drunk driver, so to speak. That's not where the money is made. The money is made selling the insurance premium. It's made collecting people's mortgages. That's where the big money is made. Owning REITs is the example for that. It's not about being right, but for the trolls, and I hate calling people trolls, all these growth stocks and all these tech stocks I slaughtered on the way up. I obliterated them. 500, 1,000% upside projections. Participating in a rally from here to here for equities. So I know it's easy to forget that after this year. And I really tried hard for the stocks that I have done well. We have had a stock pickers market to not be like, hey, I was right about this, because it's not about being right. It's about being prepared for Armageddon and being able to laugh at it, because your puts would be so deep in the money and you'd have so many covered call ETFs to reinvest against. I wouldn't give a damn. That's what it's about. But for the people who it is about being right, Neo, Roku, crypto, eCash, big tech, the market, any tech, all of them, obliteration. All right. So for those of you who it's about being right, you're not going to be around much longer. You're going to get roasted by the premium decay, betting on the car crash, ignoring risk management, thinking covered calls and long gamma strategies are for FUBUs. And to each their own. You're going to get something a lot different than me from the market. You're going to get entertainment. You're going to get dopamine. You're going to get, serotonin. Bag holder. Oh, look at this one big gain from my weekly. You're going to get something I could never get from reinvesting covered call premium and dividend premium and being so ready for the upside and the downside that I don't even really watch the market for the day-to-day action, anything other than, my own personal enjoyment. But that's your life. And you're going to get something so much more than I'll ever be able to get, which is money. You're going to get the thrill of a lifetime, right? So I'm going to look for that in other avenues. But I think this is a wave one and a wave two. It's not about being right, but for China, for growth, for, tech. This could be wave two. And if it ends at any point in the future and the risk to the downside is managed, it's 2011. It's 2009. It's the early 90s for waves 3, 4, and 5 to the upside. And for China, it could be something we've never seen before. So anyway, that's Neo. There isn't a downside level to be above right now for Neo. The institutions are using straddles. It's another one where, the perfectionists will say wait for a wave one and a wave two to develop from the low. I'm going to use, downside tactics that I've outlined. But XPEV, Lee, and Alibaba, and Huya, I'm currently holding right now, using the strategies I outlined for managing downside risk very extensively. Here is PBR Petrobras. We're going to go over a few energy names. I think in the long term, I've posted about BP. I should have included BP. But it's a very similar idea to this. A 1, 2, 3, 4, 5 waves up, large wave 1 for PBR, an ABC correction, and another wave 1, another wave 2 from this low for PBR. So if we're above 2.71, I think this is a wave 1 and a wave 2. That's extremely wide. I probably didn't mean to say that. The large wave 3 target is 27.29. Now, for the small degree, wave 1 and wave 2 from this low, I'm going to use 7 as the stop there. It's just this kind of small degree wave 2 low if I'm looking at the subdivision, but I'm really focused on PBR and UUUU. Is a little different, but energy in general for the larger time horizons. And so I wanted to include PBR as an example of that. I feel very similarly about ET and BP in kind of this, this different side of oil. So above 7, I think PBR could begin a large wave 3 up to this 161.8% retracement of 27.29. And I'll talk about other kind of commodities related names like silver, like palladium a lot in 2023, where if these impulses do happen, we could be talking about something much bigger than that. But that's enough for PBR right now. Here is UUUU. It's very similar. I should probably do IEO right after. It's a little more closely related to PBR. But I think for UUUU, this is a 1, 2, 3, 4, 5 waves up, wave 1 from the 2020 low, and a ABC correction that ended a wave 2. So from this low, I expect this is another wave 1 and a wave 2. I bought UUUU, taking a full position right here around 4.60. I sold half of it right here, about 10.70. And I'm still holding the rest of it. I think that this is a wave 1 and a wave 2. So I'm looking for UUUU to hold above 4.38 and begin a large wave 3 of wave 3 to the upside. If I'm getting, a little tight, the bulls are going to say from that's low, that's a wave 1. This is a wave 2. We're going to begin wave 3 of wave 3 as well. I'm more focused on the bigger picture. So above 4.38 is kind of the level I'm looking for, but a little tighter would be 4.69. And then stupidly tight for that really high beta would be 5.39. And we could see it get very nesty for uranium fuels and a lot of, the uranium sector. But for me, I'm looking for a wave 1 and a wave 2. The length of wave 1 placed at the wave 2 low could take UU up past 11.81 and into higher targets beyond that. For this video, I'm going to talk about, kind of just the next target since there's a lot of stocks. Here is IEO. I'm just going to talk about the short term from this low. A lot of, and it's okay to think this, that we're going to have oil correct this massive rally that oil has had. And while I'm not really the biggest fan of chasing oil, and I'm mostly playing oil right now, that's not technically true. I have energy exposure directly, certainly, but for oil specifically, my biggest form of exposure is ET, the options that I've outlined for ET, because there is the chance that oil is going to correct this entire cycle and crash, and and that's not something to laugh at. But that's not my bias. I don't think that's going to happen. I could probably do a different video about Chevron and ExxonMobil. But if we look at screw it. I'm just going to look at Chevron right now. After I do IEO, then we'll look at Chevron. Okay. If I have Chevron ready. But IEO, I think this is a wave 1 and a wave 2. I think this is another wave 1 and another wave 2 at the 61.8% retracement. So this 78.6% fib is super tight. But above 83.70, that's ridiculously tight. 77.53 is a really nice invalidation. The bulls are going to argue this is a nest. The bears are too early calling the top in oil, which is I hate using language like that because it just sounds like more of the bag holder, Cowboys versus Eagles, Bulls versus Bears, Jordan versus LeBron debate, which it's easily Jordan. I mean, come on now. A Disney. You can't win a championship with A Disney in the Bubble Bowl. Anyway, Jordan won 2 back-to-back three-peats in the 90s. What are you talking about? Anyway, wave 1, wave 2, above 77.53. This is another wave 1 and another wave 2. We can see IEO enter a wave 3 of wave 3, well past 117. Here is Chevron. Do I like chasing Chevron? Do I like... no, I don't. But it's just important to talk about. I don't think we're done with oil. I just don't. And I think that the Bears got to prove it. And Chevron, it's really hard to define risk for Chevron, but I think we're going to make a little new high for Chevron. I think this is a large wave 1 subdivided into 1, 2, 3, 4, 5 waves. That's not that it matters. I predicted and said, hey, they're loading up, delta neutral positions on oil. Anyway, that doesn't matter. Well, until they do it again, which then it will matter again, which they're doing it right now. So I guess it does matter. But Chevron did explode above this wave 1 high. The 161.8% extension of wave 1 is 213. All right. Now that's kind of the perfect target, right? Like not taking any profits on Chevron because it didn't hit the 200. It didn't hit 213. That's ridiculous. So if I ever buy a stock and it's a winner and I'm up 40 or 50% on commons, most of the time I'm going to sell the portion of that shareholding that's in profit. So for example, if I invest $1,000 in, say, a stock like Chevron at 100 and it goes all the way up to, say, 150, $1,000 has turned into $1,500 plus dividends. So I'll sell $500 worth and I still have the original position's worth of exposure. That's just a general example of profit taking 101. Okay, but it hasn't reached the 161.8% extension yet, and that's one little bit of Elliott wave evidence why a chart like IEO and UUU, definitely UUU is a little different, but IEO, calling the top in oil, I'm just not a big fan of it. I'm not going to bring up the commodities correlation, but this could be a lot bigger in commodities than we think. And I don't think, that a stock like Devon Energy breaking, a new all-time high, and even in the super long term, stocks like ET and BP making new all-time highs, I'm just not laughing at that. Here's Boeing. I'm not laughing at Boeing making a new all-time high either. Should have been right after XLI. But Boeing, 1, 2, 3, 4, 5 waves up for Boeing in the long term. But in the short term, we're even getting a little bit of love, where I think this is 1, 2, 3, 4, 5 waves up for a large wave 1 from the March 2020 low, an ABC correction now that ends at the 78.6% retracement. And the bulls are going to argue that from this low with XLI, with Honeywell and with Caterpillar, this is wave 1 and wave 2. Wave 3 of wave 3 has begun. The super far 161.8% extension is 395 for Boeing. I know that's far. The length of wave 1 place of the wave 2 low gives a slightly more shallow target in the low 300s, but those are the wave 3 targets for Boeing. I should probably spend a little more time talking about some of these airlines. Let's look at Love. I heard Love was in the news recently. I'm sure that wasn't planned in advance, you know what I mean? But Southwest Airlines, another one, 1, 2, 3, 4, 5 waves up, an ABC correction that ends wave 2. So that's wave 1, that's wave 2. The bulls are going to say this is another wave 1. That's another wave 2. Now, it's difficult to just say, hey, pick the low above 30.20, right? Because then, the low breaks, bag holder, furu. That's really tight. People in the comments aren't going to talk about beta diversification, but I just think maybe with Boeing, it's another example. This could be 1, 2, 3, 4, 5 waves up, wave 1 and wave 2. This could be another wave 1 and another wave 2. Southwest could enter wave 3 of wave 3. 22.46 is stupidly wide. Let's look at RCL. I think there might be a little, in the transportation world, there might be a little bit more levels to look at. There we go. 1, 2, 3, 4, 5 waves up for RCL, Royal Caribbean, and an ABC correction that ends a large wave 2. This could be another wave 1 and another wave 2 from this low. The bulls are going to argue that. So I'm going to put 99.24. I remember that right. Yes, 99.24. This is another wave 1 and an ABC correction that ends wave 2 at the 78.6% fib. A little wider. But 31.09 for RCL. They're going to say that wave 2's already ended. The length of wave 1 placed at the wave 2 low says it's another travel-ish name with Boeing. They can enter at wave 3 of wave 3. I posted about Expedia recently. I've posted about or I've talked about Ryanair recently, and if I haven't, I'll post about Ryanair recently or in the recent future. Time is just a flat circle. Here is Alibaba, and with that, I'm going to take a little sip. So I'm a retail bag holder. I'm a retail bag holder. I'm holding all these bags. I bought Litecoin at 229. I bought Alibaba at 165. I bought Huya in the mid 20s. I bought I don't even know where I bought Jaguar Health. Jaguar Health, that's had like 2 reverse stock splits, but I took smaller positions in them because they were growth stocks. And I took, metric dick ton positions in covered call ETFs and straddles. And, that's just the bourgeoisie or do I mean the proletariat, the middle class, the homeless people, the 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 starving, people in our society compared to the rich and the wealthy, the elites, right? They're not ever going to be on an equal playing field until covered call ETFs aren't a joke, until dividend income holdings and owning REITs and owning BDCs and looking at payout ratios and saying, hey, this stock's going to pay for itself in 8 years. I'm going to own it. And then every distribution I get after 8 years is risk-free. That's a no-brainer, and then I can own that in my own brokerage account. It doesn't have to be a Roth. It doesn't have to be a 401k where I can't touch it till, I'm in my 60s. That's, risk management can't be a joke. Passive income can't be a joke. Long gamma positions can't be a joke. Or modern slavery through the, fiat system is going to continue. I think it's a damn shame that so many goddamn baby boomers have their entire life savings in Roth IRAs and 401ks that are tracking the market, paying 1.30% or 2% dividend yields. I think that's a goddamn shame. I think it's a goddamn shame that people aren't ready for this. People aren't ready for SPY to go below 200. People think that's a joke. And people have millions of dollars, their whole life savings, everything they've worked for 45 fucking years in a Roth and a whatever. If it's paying a 1%, 2% yield, and they could lose everything. And if they don't, it's just because they were parable. I think that's a shame. I do. You know what I mean? I really do. And, the middle class, the lower class, they're never going to compete with the powers that be if they're not ready for the tough times. Because in the tough times, that's when they can say, hey, now you got to take this medication. Hey, now you got to, you got to do this or you're going to lose your job. And, you're not really going to develop your own opinion about the particular matter because we already know your opinion about your employment status. Right? You can't disagree with this. You know what I mean? Because you don't have passive income coming from REITs. You don't have covered call ETF income. You don't have long gamma positions. You're not ready for this. We know it. So if we go put a bunch of red numbers on the screen and we tell you a bat fucked a lemur had sex with a monkey, I ate that monkey's asshole out, and then I, sucked my own dick, and then I jacked off into a fucking hamburger, and a Chinese person ate that hamburger, and that's why we gotta put a mask over your children. You're gonna say, all right, all right, well, if that's what I gotta do to get my paycheck, then, why don't you put those monkey cells in me? You know what I mean? I ain't about that life. I don't think risk management's a joke. So when I invested in stocks that had high betas and they fell, I managed that position up front with risk, with position size, with covered call ETFs, with long gamma positions on growth ETFs. But I got laughed at in the 450s, in the 460s. So, hey, after a long time of hearing the bears say, hey, screw the perma bulls, hey, I think I want to join the party. Screw the perma bulls. Screw the people who think covered call ETFs and dividend income and long gamma positions are a joke. Screw the people who have their entire life savings in SPY, and they're just betting stocks only go up and they could lose millions of dollars. They don't have passive income. Screw them. I agree with the bears on that. So I took smaller positions in growth stocks. Alibaba, I honestly just took a regular position. But 1, 2, 3, 4, 5 waves up. Large wave 1. ABC correction wave 2. I think Alibaba can enter a large wave 3 to the upside. NetEase does a lot better job, kind of giving the Elliott wave defining risk view. But I think this is a large wave 1 and a large wave 2. I think this is another large wave 1. And this is an ABC correction to the ended wave 2 at the 78.6% retracement. So I'm looking for NetEase to form a large wave 3. That's at least the length of wave 1 placed at the wave 2 low. And that can take NetEase all the way to the 150s. 53.09 is the kind of pick the low. Wave 2 is already in level. Here is Goodyear Tire. I like Ford. I like Volkswagen. I'm just going to talk about Goodyear Tire in this video for autos. I think for Tesla, if I've posted about Ford and Volkswagen recently. I can probably update those soon. But for Tesla and NIO, I don't think it's too outlandish to say that Volkswagen, Goodyear Tire, and Ford are also going to be very useful charts for managing risk in those sectors. Now, Goodyear Tire, not particularly, because we're getting close to the 78.6% retracement. But I think there's just a lot of evidence that the auto sector is going to do well. And that's from an Elliott wave perspective. But this is a 1, 2, 3, 4, 5 waves up for Goodyear Tire. This is an ABC correction between the 61.8 to 78.6% fib. 8.48, a little tight. I like this wave 2 low. There's another level of 7.28. The length of wave 1 placed at the wave 2 low could take Goodyear Tire on a wave 3. That equal legs target comes out to 30. That's a little high. And I think that's maybe where a wider invalidation, that wave 2 low would come in. But that is the equal legs target. So here is JP Morgan. I think it's another one, especially where the bulls are going to say, hey, get JP Morgan and Starbucks below these lows. I mean, why I used to play a little football, and you guys can probably tell because I sound like I've had a couple concussions. But no, I've had probably 3 concussions. I never got knocked out though. I never got like knocked out. I got one in 8th grade. I got one my sophomore year where that was not a pretty one. That was a bad one because like that was one where I forgot like 3 hours of my life. And then I had another one where I didn't even know I had it until after the game when I was driving home and the streetlights were real bright. So I've only had 3 concussions. So while we're on the subject, I'm not a doctor, but if someone's playing football or if someone is playing like, a concussion sport like hockey, wrestling, whatever, or your kids are playing it, that's probably more important. They're important sports. They're great. They're really awesome. They're great. But once you're no longer doing the hitting, or once your kid's no longer doing the hitting, get them out. That's it. Because there will be a point where the people are too big. Tua Tagovailoa, he's good at football. That's not the problem. He's just too small. He's just too small to be on the field. That's it. Yeah, he's a beast. Yeah, the Dolphins are better with him. Once you're not delivering the blows, get out. This isn't basketball. It's not baseball. All right, anyway, here's JP Morgan. The Bulls are going to say, the reason that I bring that up is because in football, they say, if you give the ball to your running back and you run down the right guard's ass and you get 7 yards, you're not going to the next play throw a Hail Mary. You're not going to throw a slip screen. You're going to give that fucking ball to the running back again. And you're going to say, hey, go down that right guard's right ass again and get 7 more yards. And then once you stop doing that, then we'll start throwing, the slants and the play action and you make them stop. And we have a lot of places in the market right now where it's just like the risk to make them stop. Make them stop. Make them stop. That's what I'm thinking right now. Make them stop. Yeah, I'm ready for SPY to go below. I'm ready for SPY to go below 348. I'm ready for SPY to go to Sheol. I'm ready for SPY to go to hell. I've been to hell. I've talked to the devil. I've talked to Satan. You know what Satan told me? He said, I may be Satan, but you're the devil. I've been to hell. I'm ready for SPY to go below 200. I'm ready for SPY to go below 100. I'm ready for SPY to go below 50. But I'm damn sure ready for SPY to go below 348. But I don't think it will. Make them break 348. Make them get XLI below this low. Make them get XLV below this low. Make them get the DAX below this low. Make them get Europe UGK ETF below this low. Make them. We have so many lows in the market that are nice impulses to say, hey, wait a minute. Why don't we just make them break this low? Because what if I'm called a bag holder? Oh no! Oh no! What if I'm called a bag holder? What if I'm called a bag? Oh no! I'm gonna call me a bag holder! I'm gonna call me a bag holder! They told your parents. They told your grandkids. They told your grandkids. They told your grandparents if they didn't take some medication, they were going to starve to death. That if they didn't put on some mask forever, we didn't have children in their formative years being masked for infinity, forever, forever. Go to quarantine camp, go to whatever. That they could die in the street. And people did. They invaded a country. They told you. I said the soybeans are going to rally 30%. I said the energy, like ExxonMobil, like XLE, like Oxy, like Chevron, we're going to explode. Then someone said, if that happens in America, there's going to be rioting in the streets. There's going to be rioting in the streets. There's going to be rioting if they explode oil. And I said, they're going to explode oil. They're doing it right now. They're buying all these straddles on Oxy when it's in the low 20s, and BP and Chevron and ET and Oxy and XLE and ZOM, and they're buying all these straddles and strangles, and we can see what they're doing. And they said that this new thing came out. Now they get to buy in the money. They get to buy shares against in the money puts risk free. They're gonna explode oil. It's just like they did it to the Chevron, just like they did it to Big Tech, just like they did it to. They ever exploded oil in the United States. If they ever exploded commodity prices in the United States, they'd be rioting in the streets. They'd be rioting in the streets. Was there rioting in the streets?